All right, video number 2. Now, this kind of goes a little bit in line with the last video I did, but it is a bit separate. It's a little bit different. But again, the Federal Reserve, the Fed, is back in the spotlight. It cannot make a good decision if its life or future depends on it. Not at all. So, anyways, these are both silver doctors covering this. The first one, the Fed is almost insolvent. The other one, 3 wise men warn crash is definitely coming. You need to own some gold. It's coming sooner. So, I think sooner than we all finally expect nowadays. Because we thought this would be here way earlier. It still hasn't come, but now, again, it's all compounding. It's like a balloon filling, and it's at, the extreme of this is when the balloon will pop. We know that once you have 5 psi inside the balloon, it is going to burst. And we're at 5.3 psi. This thing should have burst 0.3 psi, pounds of pressure per square inch, ago, and it's here. So who's going to bet, oh, we could get to 6 or 7, no problem, right? Don't know if I'd feel real comfortable with that bet. And instead, I'm going to start preparing for what happens when that thing bursts. And right now, I can see precious metals is the way to go. But let's start with the Fed is almost insolvent. I thought to myself, how is a Fed insolvent? Like, how could it ever be insolvent? It just prints its own money. But the Fed prints money that the Congress has to borrow into existence. And I remember what Lindsey Williams' friend said, that the Fed would buy all these bonds, all this crap would happen, but they would only be able to do so for so long. And then they would have to stop. It would be a thing where they had to. So it would not last forever, and that's when things would get really, really interesting and not in a good way. And he said that many, many, many years ago. That was Ken Fromm, the guy who really had the information. And I'm thinking, I wonder if this has something to do with it. And this is from that guy, Sovereign Man, Simon Black. But anyway, Silver Doctors is covering this. September 10th, 2008 was one of the last normal days in the world of banking and finance. That afternoon, the U.S. Federal Reserve published its routine weekly balance sheet report, indicating that the central bank had total assets worth around $925 billion. Just a few days later, Lehman Brothers filed for bankruptcy, kicking off one of the most severe economic crises since the Great Depression. And almost immediately, the Fed launched a series of unprecedented measures in a desperate attempt to contain the damage. They called it QE, or quantitative easing, which was a fancy way of saying the Federal Reserve was printing money and giving it to the banks and the U.S. government. When the commercial banks needed to sell their non-performing toxic assets, like all those mortgages I just talked about in my previous video, that they gave them 100 cents on the dollar, the Fed printed money to buy that garbage. When the U.S. government needed to borrow trillions of dollars to bail out failing companies, the Fed printed money and loaned it to Uncle Sam. By January of 2015, the size of the Fed's balance sheet had more than quadrupled to $4.5 trillion. And again, normal is around $0.5 trillion. Before they even started this, it was already up to $900 billion. It was an astonishing increase. The Fed had essentially conjured more than $3.5 trillion out of thin air. In exchange for all that money, that printed money, the Fed had purchased a bunch of assets, including about $2.4 trillion worth of U.S. government bonds. But I thought China and Japan were the #1 buyers of our debt. I covered that years ago, a few years back. They used to be #1, #2, and the Federal Reserve #3. Now Federal Reserve is #1. Little 80s song, or maybe this is earlier. I wanna be your #1. And the Fed sure as hell is now. This ranks the Fed as one of the top owners of U.S. government debt. Hang on. I got something in my mouth. Here we go. Little miniature Fed burger in there. This ranked the Fed as one of the top owners of U.S. government debt, just behind the Social Security trust funds. Ooh, let's not even get into that unfunded liability. In fact, the U.S. government owes more money to the Federal Reserve than to China, Japan, and Saudi Arabia combined. Now remember that interest rates were at historic lows during that time, that the Fed was buying up all that U.S. government debt in the toxic mortgage-backed securities. From the start of the financial crisis in September of 2008 until the day the Fed's balance sheet peaked in January 2015, the average yield on the 10-year U.S. Treasury was about 2.6%. That's close to where the 10-year yield is today. Just last week, it was 2.62%. This is where things quickly get out of control, he says. If you don't know anything about bonds, there's just one important principle to understand. As interest rates go up, bond prices go down. Just like shares of Apple or Exxon, bonds are financial securities. Investors pay a certain price for bonds, just like they pay a certain price for Apple stock. And just like stock prices, bond prices go up and down. Think about it like this. Let's say you own a government bond that pays $25 per year interest. That's $25 per year, and it's set in stone. It is a contract. And today, the market price for that bond is $1,000, okay? So in very simple terms, an investor is paying $1,000 to own that bond, and really it's $25 per year income it's going to provide. That works out to be a 2.5% annual return, not including maturity. At the moment, investors are happy to receive 2.5% because that's the current rate across the most of the market. But let's say tomorrow the Federal Reserve jacks up rates to 10%. And I realize he's doing this to show you some simple math. They're not going to jack it up to 10% that fast. But it makes a good point, and that's why he's using this example. So let's say they jack up rates 10%. Everything changes. Investors can now make 10% just holding money in a bank account. Don't have to invest it, stocks up and down. Nope, just put it in the bank and earn interest. 10% at that. Everything changes, he says. Investors can now make 10% just holding money in their bank. The bond you own, however, is still paying $25 a year. That has not changed. So if you want to sell it, you'll have to slash the price. No investor will pay $1,000 just to earn 2.5% from the $25 a year income stream. Investors can now get 10% elsewhere in the market. So in order for your bond's $25 a year income stream to match the 10% return that a potential buyer can receive elsewhere, like in their bank account, you'd have to drop the price from $1,000 to $250. In other words, the price of your bond just dropped 75% from $1,000 down to $250. This is an extreme and simplistic example, but it paints the picture. When interest rates rise, bond prices fall. And I'm here to tell you, investors don't have to see 10% before they make that move. You just give them 3 or 4% and they're gone. If they're at 2.5% now and they own however many bonds, and again, the example is $1,000, that's going to stop instantly. They're going to sell that bond as fast as possible before everyone else catches on that the rates are rising and the bond prices are going down, so that they can get that money and then invest where the interest rates are, which is, in this case, your bank account could do it because the Federal Reserve raised rates. So you're not going to see 1,000 turn to 250, but you can see 1,000 quickly turn to 800, 750, 700. And what happens when an influx of people trying to jump, front run everybody else decides, let's get out of these bonds all at the same time? And then everyone else thought the same thing too. Now you're flooding the market with all these bonds. Who's there to buy them? Now, naturally, you might think, well, maybe the Federal Reserve would have to step in and buy them. Don't know about that. So let's get back to the Federal Reserve and its $2.4 trillion with its government bond portfolio. The Fed recently raised interest rates, and they claim they'll continue to do it for the next 1 to 2 years. But as we discovered earlier, as the Fed raises rates, the value of their bonds will fall, and the Fed will suffer unrealized losses. So not only that, your China, Japan, and Saudi Arabia and the OPEC nations, we don't want to hold these failing, securities, if you will, these treasuries. Unload them. And what happens when a bunch of these countries that have massive amounts of U.S. debt dump it on the market? I think it's not going to be a good day. Fed balance sheet $4.5 trillion. You plan on reducing it? I would say not a chance in hell. This is a gigantic problem because the Fed can't afford to suffer any losses. Since the start of the financial crisis, the Fed has whittled down its capital buffer to almost nothing, right around $40 billion. This means that the Fed can only afford to lose $40 billion before going bust. Stand by. So that was my papa. I should have recorded that conversation with speakerphone on. You'd have probably enjoyed it. Hey, tell me about your, I saw your video about foreclosure. Your credit score has now been wiped clean of the foreclosure. I don't want to have to sit here for 30 something minutes. Can you just give me the short story? That's my pops. Yeah, look, remember that day I talked to you and you said you some jabroni tried to put something on your credit score and you called and like a day later it was gone. You disputed it, and I said, yeah, maybe I should try that. Yeah, well, I did, and now my foreclosure is completely off my record. So then we went on to have a nice conversation about the sheep, how nobody would do this, that why are we playing the game with these companies, with the club, with the whole credit scam, credit number, it's a credit report, it's their credit system, it's not ours. Why are we dealing with this? You know, good for you, good for me, good for the people who stand up and dispute it. It just goes to show you that these people, when you play the game back with them, they crumble like a house of cards. It was a good conversation. It was about a good 10-minute conversation. But that was already discussed, so I'm not including it in this video. I thought you just might like it, though. So, see where I was at with this one. So it says, this is a gigantic problem because the Fed can't afford to suffer any losses. Since the start of the financial crisis, the Fed has whittled down its capital buffer to almost nothing, which is right around $40 billion. This means that the Fed can only afford to lose $40 billion before going bust. $40 billion might sound like a lot, but considering the Fed has $2.4 trillion in government bonds and $4.5 trillion in total assets, $40 billion is nothing, just 0.9% of the Fed's total asset portfolio. So if bond prices fall by 0.9%, i.e. interest rates go up just slightly, the Fed will be insolvent. This is already happening as interest rates have risen, bond prices are starting to fall. And based on the Fed's own data, they're already sitting on $14.2 billion in net unrealized losses. So a big chunk of their tiny $40 billion capital buffer has already been wiped out. As interest rates continue to rise, the rest of that $40 billion will vanish, at which point the Fed will be completely bankrupt. And the U.S. government, which itself is totally insolvent, won't be in a position to bail them out. Look, I'm an optimist. I think these are exciting times and that there's a ton of incredible opportunity around the world. But it would be seriously foolish to ignore the looming insolvency of the world's most systemically important central bank. 2 words, own gold, he says. Which brings me to the other article I want to get onto, because we've got Jim Rogers, Martin Armstrong, and Tony Robbins all warning, buy gold now. A financial crash is coming. 3 wise men are warning that the next financial crash is coming and that one of the ways to protect and grow wealth in the coming crash will be to own gold. The men who have recently warned are Jim Rogers, and there's a video, which again, I'll link these articles. You can check them out and watch the videos if you'd like. Martin Armstrong and Tony Robbins, videos below, each come with somewhat different backgrounds and are respected experts in their own respective fields. Each has different views in terms of asset allocation and how best to weather the coming financial storm, but all are united in believing that gold will act as a wealth preservation tool and will likely rise in value when all other assets fall. Jim Rogers is a world-renowned investor who co-founded the Quantum Fund with fellow investor George Soros. He is an investor, traveler, financial commentator, and author who believes that this will be the Asian century. And all I can think of, again, is Ken Fromm, Lindsey Williams' friend. Watch China. Lindsey, watch China. China's the big one. In his usual plain-speaking, honest manner, Jim Rogers warned on Bloomberg TV that the Federal Reserve has not a clue what they are doing. They are going to ruin us all, he said. Central banks have driven rates to all-time record lows, and in the process, debt has skyrocketed. Rogers slams the counterfactual arguments that things would have been a lot worse if the Fed had not done all this. Quote, propping up zombie banks and dead companies is not the way the world is supposed to work. It's been 9 years, and we have nothing to show for it economically except staggering amounts of debt, he said. Rogers is pessimistic about the outlook for America and thinks that Donald Trump will see the U.S. continue on the path to bankruptcy, a path set by Bush and Obama before him. And I'll go back further, Clinton, Papa Bush, and Reagan, etc. And back, again, 1971, the time we got off the gold standard, that's when the national debt started going up significantly and just absolutely ballooning out of control constantly. He concludes the Bloomberg interview ominously by saying that this is all going to end very, very, very badly. In recent years, Rogers has consistently said that he wants to own more gold and silver and will continue to accumulate the precious metals on any price dips. Financial analyst and trends forecaster Martin Armstrong warned on his Armstrong Economics blog this week that governments are in increasing trouble and people will start to lose confidence in their governments. Gold in the stock market will take off, he says, when people realize that the government is in trouble. When they lose confidence, that is when they start to pour into tangible assets. Armstrong is nervous about gold in the short term and thinks it could fall as low as $1,000, which he's said that for a while now, per ounce prior to surging to as high as $5,000 per ounce in the coming years. Tony Robbins, performance coach and self-help guru, has warned that the crash is coming. Robbins, who is focusing more on finances and wealth in recent years, and in his latest book, Money, Master the Game, says plan now for what's to come. Things may be looking rosy on Wall Street as of late, but the crash will come, he says. We are in a really artificial situation. There is a new high, on average, every month. Feds around the world have been printing money, he said in a TV interview. Robbins has long advocated owning gold as part of a diversified portfolio and has cited Kyle Bass, Mark Faber, and more recently Ray Dalio as his financial gurus. In his recent book, Robbins cited Dalio and recommended an asset allocation strategy that involves 7.5% allocation to gold. I'm going to share this picture with you because I'm going to tell you how I would do it. He says gold 7.5%, commodities 7.5%, stocks 30%, ooh, intermediate bonds 15%, and long-term bonds 40%, ooh. No, I think I'd be heavily into gold and heavily into commodities, and what's left into something like Bitcoin. Okay, that's how I'm rolling. So, given the increasing risks of another financial crash, the warnings from these very different three men should be taken heed of. They underline the importance of being prudent, of real diversification, and of owning gold. The smart money sees what is coming and is once again preparing. By the way, I'll add when I said gold, commodities, whatever, Bitcoin, add a third one. The mining companies, metals mining companies, and that goes for any metal. Precious metals, hell, even copper. The other guys I was talking to today, cobalt, some of the alt metals, if you will. The mining companies, the junior miners, I think will have explosive, like never before seen explosive growth in their stock prices. And again, I keep looking at First Majestic and some other junior miners. I've mentioned a few over the I don't know, maybe last year or so. That's how I'd be spreading my love. Find a bunch of these junior miners and different alt mining companies and just kind of pile up. That'd be my portfolio. This one, that company, this one, that one, that one, that one. And then got my physical silver. Gold, again, you know me, I used to have a little bit of gold. I sold it, and I'm 100% silver because I'm just so confident there'll be way more well, not necessarily an uptrend, just a performance-wise, I guess you could say silver should do better than gold. It's at 70-to-1 ratio with gold right now. It should be 20-to-1, 15-to-1. It's 70. That's why I think when this all starts to go to hell in a handbasket, you're going to stand and look really, really pretty in your silver portfolio. Although you'll look pretty in your gold portfolio too, you're going to look really pretty with your silver one. So that's it for right now. Got one more to go. That is video. Take care.